So, what the heck is yield curve control? Because it sounds like something a Jedi would do, not a central bank. Now, as its name would suggest, yield curve control aims to control yields of government debt securities like treasuries.
Right.
In doing so, a central bank prevents those yields from getting too high, which keeps interest payments and refinancing costs down.
My man!
But before I get into the weeds, it will be helpful to briefly explain quantitative easing, because yield curve control is essentially the next step in monetary easing policies when QE is no longer cutting it.
And we say bye-bye!
I'll spare you the long answer of what QE is and does, though you can check that long answer out in the link above, but one of the main goals of QE is to lower interest rates.
Totally!
By lowering interest rates, central banks are attempting to encourage lending and thereby drive credit and overall economic activity. However, central banks are also attempting to lower the cost of rolling over their debt.
Say what?
When countries issue bonds, they are issuing debt with an interest rate. This is a fairly standard practice, but when a country accumulates too much debt, it can't always afford for its interest on that debt to get too high. Paying 5% interest on a few billion is no big deal for most countries, but paying 5% interest on trillions can consume all or even more than all of that country's tax receipts, which is essentially the country's income.
Not crazy.
So avoiding high interest rates is sometimes necessary to avoid a debt spiral or sovereign default. Now, if QE, which usually consists of a predetermined amount of money a country is willing to spend buying its own debt, isn't enough to hold rates down, and higher rates are a serious threat to that country's financial stability and solvency, yield curve control is the next batter up.
Woo!
The key difference between yield curve control and QE is yield curve control commits to a specific interest rate, not a predetermined amount of bond purchases, meaning yield curve control can theoretically lead to an infinite amount of bond buying.
Whoa.
Under yield curve control, a central bank might commit to keeping interest rates at or below 1%, whereas under QE, it might simply commit to buying $30 billion in bonds each month, regardless of where that leaves interest rates. In other words, under yield curve control, the central bank will buy as many bonds as it has to keep yields at or below the desired level, even if that means $30 billion in bonds one month and $100 billion the next month.
Oh, hell no!
An example of this policy in action is Japan, which has been engaging in yield curve control since 2016, pinning their respective 10-year yield at or around 25 basis points.
Damn!
If the yield rises beyond that level, the Bank of Japan will print yen in the form of bank reserves and start buying those bonds until the yield gets back in line.
Little bitch.
Interestingly enough, Japan's goal with yield curve control was actually to generate inflation of 2%.
What?
Something it has largely failed to do for the last couple decades because of a number of deflationary headwinds, most notably its demographics.
Totally!
So, while it's possible for yield curve control to have positive effects when fighting deflation, 1, it is by no means a guarantee, and 2, it is still a form of price suppression that can be at stark odds with natural market prices, especially if inflation gets out of hand.
Yep.
Just bear in mind that any battle against a central bank that prints its own currency is all but impossible to win in the short term. But a price cap constantly at odds with the market will inevitably lead to something going very wrong due to all that built-up volatility. With that in mind, one of the most important considerations around yield curve control is the government engaging in it, assuming its debt is denominated in its currency, has an unlimited balance sheet. So there is no limit to how many bank reserves it can print to defend a particular interest rate.
For real, you fuck with that?
The market can try to fight a central bank, but it probably won't get anywhere until all that built-up volatility finds some sort of release valve, whether that's the bond market, currency, or something else. That said, when a country artificially pins its yields through yield curve control, the release valve is usually the value of its currency.
And we say bye-bye.
meaning its currency can rapidly devalue to the point its economy becomes disorderly. A rapidly devaluing currency can lead to massive import inflation, complicate business expenses and investment, and lead to price distortions all throughout the economy. So the potential consequences of yield curve control-induced inflation can be rather extreme. If a central bank can keep inflation under control, yield curve control may not lead to serious problems, but an irrational or excessive use of yield curve control will likely scare a lot of investors out of that currency, thereby driving the inflation.
Come on, man.
At that point, the central bank will have to make a very tough decision. Let its interest rates rise and risk a nominal default on its debt, because don't forget, it can always print its way out. Or let its currency rapidly inflate by remaining steadfast in its yield curve control policy. Both scenarios are far from ideal, so any central bank caught in that dilemma would just be left choosing the lesser of two evils. Either way, it's not a good place to be. So, just to summarize, yield curve control is when a central bank commits itself to an unlimited amount of bond buying to pin its interest rates at a specific level. There can be a wide range of reasons this is done, but the main reasons are almost certainly QE wasn't enough, the country is heavily indebted, and that country can't afford to pay higher interest rates on that debt. Alright, that is all for this 101. But as always, stay happy, humble, and most importantly, solvent.
And we say bye-bye.